Okay, we have some questions related to bond pricing. Okay, we'll do it now. Okay, we'll try to solve it. The first question, bond pricing, starts from question number 30, but question number 30, since it is easy, so you can do it on yourself. Just put the formula and you'll get the answer. Question number 31 is easy. Okay, just one point here, so I'll just read the question and the main point we'll discuss it so that you don't make the same mistake. Okay, Mrs. Agarwal Limited is planning to issue a debenture series on the following terms. For face value is 100, term on maturity is 10 years, yearly coupon rate years 1 to 4 the coupon rate will be 9%, 5 to 8 the coupon rate will be 10%, 9 and 10 the coupon rate will be 14%. Okay, what is coupon rate? Coupon rate is the interest you get by investing in a security. Okay, so how much will you get? First year it will be 9 rupees, 10 rupees and 14 rupees for every corresponding years. Okay, the current market price on similar debenture is 15% per annum. Okay, that is the similar securities having 15% per annum. We can take this as discounting rate. Okay, but the company says, the question says something further. We have to guess it. The company proposes to price the issue in such a manner that it can yield 16% compounded rate of return to the investors. So what it is saying, that the company can yield 16%. If the company can yield 16%, then we will take 16% as the discounting rate. Okay, this is the only thing. The company also proposes to redeem the debentures at 5% premium on the maturity, determine the issue price of the debentures. So 5% premium means what? 100 plus 5%, it is 105, and the determine the issue price of the debentures. It is the intrinsic value. They are asking that how much should we invest in the company at the starting point. That is what they are asking. Calculate amount up to 3 decimals. Okay, fine. So what will you do? For the we will calculate, we will see the years. Okay, 1 2 3 4 5 6 7 8 9 10. The cash flow 9% was to 4 years, 9%, then 5 to 8, 5 6 7 8, it is 10%, 9 and 10 it is 14%. Okay, in the 10th year only they will give redemption amount, that is 105 also. Take care. Then it can yield how much? 16%. Okay, it can yield 16% rate, which means the discounting rate is 16%. 16% factors, you have to write it. Okay, and PV it and you'll get an answer. Okay, so basic sum, just yield of 16%, that was the main catch. Okay, so the next one we'll move, it is what? Question number 32. Okay, question number 32 has one special point, we'll see that. Okay, Pet Feed PLC has outstanding a high yield bond with following features. Face value is 10,000 euros. Okay, 10,000 pounds. This is pounds. Okay, coupon rate is 10%, that is 1,000 you will get every year. The maturity period is 6 years. Okay, the redemption period is 6 years. Special feature, company can extend the life of bond to 12 years. Okay, this one is important. Okay, this is a special feature that after 6 years the company can extend its life up to 12 years. Okay, presently the interest rate on equivalent bond is 8%. If the interest in equivalent bond is 8%, that means on similar bond it is 8%. We will take this as discounting factor. Okay, if an investor expects that interest will be 8%, okay, 8%, 6 years from now, then how much he should pay for this bond now? Okay, if he is expecting that the interest will be 8%, that is the discounting factor will be 8%, he expects that how much 6 years from now, how much should he pay for this bond now? Okay, that means what they are putting, what they are asking that intrinsic value. Okay, so how we will solve it? Just normally, okay, how will we solve it? 1000. Okay, this is my coupon rate. Coupon rate is 10%. 10,000 into 10%, it is 1000. Okay, 1000. Okay, then what is my discounting rate? It is 8%. Okay, we'll do PVAF. Okay, present value annuity factor. 1 2 3 4 5 6. Okay, 6 times we'll do it. We'll press GT and we'll take this amount. Okay, we'll take this amount into how much? 1000. This is my interest component, PV of all interest received. Okay, we'll take this, and then at the end of the year, what we will get? We'll get the redemption amount also. What is its PV? We'll do it 1.08 divided by 1 2 3 4 5 6 into 10,000. We get 630 M plus MRC. 10,925 is my answer. Okay, it's matching with that. 1 or 2 rupees, it's fine. Okay, the next point is important. The next point is what is why we took this question. Suppose on the basis of that expectation, he invests in the bond, but interest rate turns out to be 12%. Okay, now the discounting factor has turned out to be 12%. Okay, 6 years from now, then what? 6 years from now, then what will be his potential loss or gain if the company extends the life of the bond for another 6 years? So 6 years has been completed. Okay, after 6 years, what happens? The investor, the interest rate turns out to be 12%. Okay, then how much will he earn? So we'll do normally only, but we'll just take that the interest rate, that is the discounting factor, should be 12%. 1.12 divided by 1 2 3 4 5 6 7 8. Sorry, 1.12 divided by 1 2 3 4 5 6. Okay, 6 times we did GT, and we'll multiply it with 1000. Okay, 1000 interest rate, 1000 is my coupon rate. Okay, coupon rate into PVAF we did. So what we got? PV of interest we got. Okay, PV of coupon we got. How much? 4,111. 4,111. Okay, then what happens? What then 10,000 also. 10,000 also, how much? How can we do it? 1.12 divided by the redemption value, you have to PV it, right? So that's why, that's what I'm doing here. 1 2 3 4 5 6 into 10,000 equals 5066. Okay, M plus MRC. So how much value did we derive from the intrinsic value derived? It is 9177. Okay, 9177.72. Okay, this is what my income is. Okay, this is what my intrinsic value is. This is what my intrinsic value is. So what is it asking? Then what will be his potential loss or gain if the company extends the life of the bond for another 6 years? If the company extends the bond for another 6 years, his loss will be how much? For the first 6 years, how much was it? 10,923. Okay, now how much is it? 9,177. Okay, so how much is the difference? 923 minus 1745 will be his loss. Okay, 1745 will be his loss. Okay, only the second point was tricky. Okay, that we have to solve. We'll move on to the next question. Okay, this is an okayish question. Okay, that one thing I have explained in example also, that was question, that point will come here, that expected market price and beta and something. Okay, that we'll see. ABC Limited wants to issue 9% bonds redeemable in 5 years at its face value of rupees 1000 each. Okay, 1000 is the face value of the bond, redeemable period 5 years, and the coupon rate is 9%. Okay, how much will it get? 1000 into 9% will get 90 rupees. 90 rupees interest coupon we'll get every year. The annual spot yield curve for similar risk of bond is as follows. Okay, the spot yield curve which we discussed, that every year the discount is different. Okay, that point is coming here, that is will discount the that is we will multiply the interest rate with the discount rate of each year in each rate with each year. Okay, for the first year, how will we do it? 90 was our value, right? 1.12 divided by 1 time. Okay, this is my first year's end value, and PV factor, okay, into how much? 90. I'll M plus it. Okay, next what happens? Same 90 we get every year. Okay, into how much? 11.62. 1.1162 divided by 1 2. We'll do it 2 times into how much? 90. Okay, equals M plus. And for the third year, how much is it? 1.1133 divided by 1 2 3 into 90. How much we get? We'll M plus it. Okay, next 1.1106 divided by 1 2 3 4 into 90. Okay, it is coming 59 M plus 1.1080. 1 2 3 4 5 into 90. Now 330.86. This is what? This is my PV of coupon. Okay, PV of cash inflows we got. Okay, now next what happens in the 5th year? We will also get what? We will also get redemption value. Okay, so we'll use the same interest rate divided by 1 2 3 4 5 into what was my face value? It is 1000. Okay, equals 598 M plus MRC. This is my total intrinsic value. How much is it? 928.696. Okay, so is it right? Yes, 330 we got. Okay, and the next we got 598, and the total we got 929.69. we got here, it is 66. Okay, some rounding of error is okay. Okay, 929 we got. Evaluate the expected market price of the bond if it has a beta value of 1.10 due to its popularity because of its lesser risk. Okay, so here what is happening? Due to lesser risk, it is gaining popularity. Because lesser the risk, okay, people will be very much interested in investing in bonds. Okay, if there is no risk, people will invest in the bond, so its value increases. So how much is the beta into 1.1? Okay, we'll get expected market price. So 1022. How much we are getting? 1022.63. Okay, fine. Interpret the nature of the above yield curve and reasons for the same. What do you find in this? The first year it was 12%. The second year it was 6.2, 6.33, 0.680. You can see that it is declining. Okay, when it is declining, the curve is inverted. So what is it? It is recession period might be going on. So that's why this is inverted curve. So that's what they have also said here. Forthcoming recession and inverted yield curve. Both these keywords, if you write in exam, you will get full marks. Okay. So we will move on to the next question of bond pricing, which is the last question of bond pricing. Then we'll move on to bond yield. Okay. Bond pricing we have to find in rupee terms. Bond yield we have to find in percentage terms. Okay. That's the basic difference. So we'll move on to the next question. What is it? It is an easy question. Okay. On 31st March 2022, the following information about bonds is available. Okay, fine. Zero coupon, it is face value 10%, face value 10,000. Maturity date is 10 years down the line. Okay, coupon rate, we won't get coupon rate in zero coupon bonds, and no dates also. T-bill, 1 lakh is the face value. June 2022 is its maturity date. Okay, we are seeing it as on 31st March, so it will mature in just 3 months. Okay, less than 3 months. We'll have to less than 3 months in days only it is. Okay, so how much is the days also we have to find it. Okay, here some examples are given, some more questions are given, that is 10.71, 31st March coupon rate this much. Okay, 10% GUI 2027 100, 31st March 2027 10, 31st March and 30th September, that is half yearly. Okay, half yearly it is paying. Okay, so here we have to multiply the duration into 2, and we have to calculate, we have to lessen the interest by 5, divided by 2%. Okay, divided by 2. Okay, and we have to take it as half yearly period. Okay, 3 things we have to do, that we'll see. Okay, now we'll find out the requirement of the question. What is the requirement of the question? If 10 years yield is 7.5% per annum, what price the zero coupon bond will fetch on 31st March 2022? Okay, if what is yield? Yield is the return. Okay, yield is the return. If 7.5% per annum, 10,000 into 7.5%, 750 is the yield. Okay, what price would it fetch? Okay, divided by 10,000, 7.5% was the yield, right? On 31st March 2022. So we'll have to just discount it. Okay, nothing much. We'll have to just discount it. Sorry. How will we calculate zero coupon bond? Face value divided by face value into redemption value. Okay, redemption period PVF. Okay, sorry for that. Okay, if it's 7.5, yield is 7.5, 1.075 divided by how much? 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. Okay, into how much? 10,000. How much we are getting? 4851, 4852. Okay, it's the same. Next, T-bill. T-bill is what will be the annualized yield of if the T-bill is traded as 98,500. Okay, what is the annualized yield? Annualized yield means what they are asking. They are asking that how much will it be. This is for some period only, no, less than 1 year. So for 1 year, how much is the interest rate? They are just asking how much is the interest rate. So how can we calculate it? Its face value is 1 lakh. Okay, how much did we buy it for? 98,500. Okay, we got 1,500 as its profit. Okay, so 1,500. So for how many time it is? For how much time is it? For what did we invest? We invested 98,500. Okay, so what is my yield? My yield is 1.52 for this period. Okay, for how many period also? For how many days am I holding this? It is issued on, it will mature on 20th June 2022. So what will be my annualized yield for the whole year? How much will it be? So 20th June, right? So 30th April. Okay, 30 days in April, 31 days in May, and 20 days in June. Okay, 81 days. So if 81 days, it is 1.5%. Okay, 1.51%. How much will it be for 365 days? Okay, 365 into 1.51 divided by 81. So 6.86 it is. Okay, 6.86. Okay, next, if 10.71% GOI 2032 bond having yield to maturity is 8%. Okay, this is the name of the bond, 10.71 GOI 2032 bond. Okay, this is the coupon rate, this is the name of the bond. Okay, having yield to maturity is 8%. Okay, yield to maturity means what? It's YTM. It will be used to calculate the intrinsic value of the bond. Okay, what price would it fetch on 1st April 2022 after coupon payment of 31st March? Okay, they are just asking us what is the price, intrinsic value they are asking. Okay, so how much is it? It's face value is 100. Okay, 100. So 10.71 is my interest we are getting. Okay, 10.71 is the interest we are getting. So what? Okay, so how will we do it? We'll take 1.08. They have already given us discounting rate. So okay, 1.08 divided by 1, 2, 3. My calculator is not working. Wait a second. Okay, 1.08 divided by 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. So we'll do GT into how much? 10.71 is my rate. Okay, equal to how much we are getting? 71.86. Okay, we'll do M plus. Okay, 1.08 divided by 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 into what was my face value? 100. Okay, this will be getting in the 10th year. M plus MRC 1.118.18 is my value. Okay, 118.18 is my value, is my intrinsic value. Okay, next, if 10% GUI 2027 bond having yield to maturity is 8%. Okay, what price would it fetch on 1st April after coupon payment of 31st March? Okay, what they are asking is 10% is its coupon rate. Okay, yield to maturity, the discounting rate is 8%. They have given it. So what would be its intrinsic value? They are asking. So to calculate intrinsic value, what we do? We do PV. Okay. So what is given here? In question, as we can see that the maturity date is 31st March 2027. Its coupon rate is 10%. Okay, but the coupon dates that it is being paid twice a year. Okay, it is being paid half yearly. Okay, so what we'll do? We'll split up the coupon rate into half. Okay, the maturity period into 2. Okay, and the discounting rate to half. Okay, so 1.04 divided by 1, 2, 3, 4. We'll have to do it 10 times. 1.04 divided by 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. Okay, we'll do GT. Okay, into how much? 10. 81.10. Okay, we'll do M plus. Okay, then 1.04 divided by 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. Okay, so it will be with 5 only. I by mistakenly did 10. Okay, it will be with 5. Okay, and 100 into our discounting rate of 1.04 into the 10th year. Okay, 10th time, and we'll get our answer. Okay, simple. Now we'll move on to bond. Okay, bond yield. Okay, bond yield, what we have to do here, it is that we have to find out our interest rate. Okay, we have to find out in percentage. Okay, we are going to do bond yield question, and this question we just have one point in it, so I'll explain to you. Okay, based on the credit rating of bonds, Mr. Z has decided to apply for the following discount rates for valuing bonds. Okay, credit rating, discount rate they have given. Credit rating is AAA, AA, What is credit rating? Credit rating is given by CRISIL, CARE. These are credit rating agencies. They give credit rating based on the performance of the security. Okay, how much safe is it? How much valuable it is? They give rating to agency. AAA means best. A means okayish. Okay. Discount rate. Discount rate, they have given something. 364 T-bill rate plus 3% spread. AAA plus 2% spread plus 3% spread. AAA plus 3% spread. Which means what? Which means that AAA rating plus 2% we have to add it. Okay, that's the basic meaning. Okay, spread means we have to the difference we have to add it. Okay. He is considering to invest in AA rated, okay, AA rated, on 1000 face value bond currently selling at 1025, okay. Our intrinsic value they have given it, okay. 1000 is the face value. The bond has first 5 years to maturity and the coupon rate on the bond is 15%, okay. Coupon rate is 15%, that is we will get 150 rupees. 100 into 15%, 1000 into 15%, it is 150, okay, payable annually, okay. The next interest payment is due 1 year from today and the bond is redeemable at par. Okay, it is just for 1 year they are saying. Okay, there is no big maturity period, it's just 1 year they are saying. Assume the 364-day T-bill to be 9%. Okay, 364-day T-bill, it is 9%. So what will be my discounting rate for this one? Okay, so how much is it? We'll see. So my discount rate for this was how much? 364-day bill was 9% plus AAA rating plus 3% spread, right? It was 12%. So I am investing in AA security, AA credit rating. What should be my interest? AA rating means the risk is more, okay. It is less safe, so the risk is more. So we'll discount it more. We'll want more return, okay. Plus how much we want? Plus 2%, okay. So 14% is my required rate, okay. So 14% is my discounting factor. You are required to calculate the intrinsic value of the bond of Mr. Z should he invest in the bond, okay. We have to calculate intrinsic value. First we have to calculate intrinsic value. So how will we calculate intrinsic value? We'll take 1000, okay. 1 point. Sorry, it seems I made a mistake, okay. The bond has 5 years to maturity, okay. The bond is for 5 years, okay. So we are required to calculate intrinsic value of the bond. How will we calculate? 1.14 divided by 1, 2, 3, 4, 5, okay. 5 times GT into what? My interest rate, which is 150, okay, M plus, and the face value we have to redeem it at 5th year end. What will be its PV? Okay, 1.14 divided by 1, 2, 3, 4, 5 into 1000 equals M plus MRC. My intrinsic value is 1034.33. Okay, only minor difference, okay. 1033.80, 1034.33 we got in calculator, okay. Should he invest in the bond? The bond is selling at 1025, but the intrinsic value is 1034. Since intrinsic value is more than selling price, then we should invest in it, okay. So here also they said that you should buy the bond, okay. Next, also calculate the YTM of the bond, current yield and YTM of the bond, okay. They are asking current yield and YTM of the bond. What is the formula for current yield? Current yield is your interest, okay, only interest divided by the amount you invested. How much amount you got? You got 150, right? 150 is the amount you got, yes, divided by your current selling price. your current selling price. How much is it? 1025.86. Okay, how much is the return you got? 14.62. Okay, current yield you got how much? 14.62. How we will do? We'll just take 1 year's thing only. Okay, for the first we'll take the interest value. Okay, just interest is same for all, and we'll divide it by the 1025. Okay, the price at which we bought it. Okay, so 14.62 is my current yield. What is my yield to maturity? Yield to maturity we need two rates. Okay, yield to maturity we need two rates. So at what rate will it be 1025? Okay, that's what they are asking. We'll see what will it be. Okay, so we have been given two rates, 14 and 15%. 14 and 15%, between that we might get it. Okay, so I'll just show you the solution. Okay, so they took two rates. First, we already did it with 14%, right? So 1033 is our one rate. So we need next rate, 15% only. At 15%, how much will we get? At 15%, we'll get 999.80. Okay, now we have to just do interpolation. Okay, 10, how much rate do we, how much price do we, what is my required value? It is 1025.86. and how much it lies in between, right? 14% and 15%. At 14% I am getting 1033, and at 15% I am getting 999.80. I need in between, that is 1025.86. So how much will it get? If you do interpolation, 1033.8 minus 1025.86 divided by 1033.8 minus 999.8. So 0.23 into, what is the difference in between? It is 1% into 1%. Okay, plus what is my lower rate? It is 14. So 14.23 is the answer. Okay, 14.23. Okay, 14.23 is the answer. Just the 2% spread, it was important here. Okay, for the discounting factor. Okay, 9 plus 3 plus 2. Okay, 9% was the 364. 3 plus 3% was given already up, and here we have to add 2%. Okay, that was the important point there. We solved it. Next, 36 is your homework. Okay, it is very easy. The same question like 35, so you can do it. So next, 37. Okay, 37. What is it? We'll read it. Today being 1st January 2022. Okay, today's date is 1st January 2022. Ram is considering to purchase an outstanding corporate bond having face value of 1000. Okay, 1000 is the face value. Okay, and it was issued on 1st January 2020. Okay, 2 years ago, wala bond, which has 9.5% annual coupon rate and 11 years of original maturity. So what is the period? 2022 2020. So okay, they have already given it. Okay, it is maturing on 31st December 2030. Okay, 31st December 2030 it will expire, it will mature. Since the bond was issued, the interest rates have been on the downside, and it is now selling at a premium of 125 per bond. Okay, since interest rates have been come down, interest rate means what? The industry rate has come down. The bond is now selling at a premium of, everyone will be interested in buying risk-free securities, so that's why it is selling at a premium of 125.75. Okay, so how much is it selling for? 1125.75. Okay, determine the prevailing interest on similar type of bonds, that is, if it is held till maturity, what shall be, which shall be at par. Okay, so what they are asking is to find the discounting rate or YTM. Okay, that's what they are asking. PV factors 6 and 8 they have given. Okay, in between only it will be. So here only the main catch was the main catch is what will be the period. Will it be 11 years or will it be 9 years? That is from 1st January 2022 or from 1st January 2020. When are we considering to purchase 1st January 2022? So 1st January 2022 will be my 0th year. Okay. When will it mature? 2030. So only 9 years. Okay. So 9 years will be my period. Okay. For that, you can even find it out by like this. See how much PV have we given? 9. Okay. So 9 is years which we have to do it. So if we do PV by IRR method, then you will get the answer. Okay, 2 rates 6% and 8%. We will get 2 rates. We will do interpolation. Okay, by interpolation we can get the proper thing. Okay, the rate is 7.55%. Simple thing. Only one thing I had to explain, that the period is 9 years only. Okay, it is what it is from the date when we are investing and not the date when it was issued in the market. Okay, that you have to keep in mind. For that this question was ticked, rest it was easy. Okay, another question will solve. Just 2 more questions and we'll call it a day. Okay. So what it is, question number 38, a hypothetical company ABC Limited issued 10% debenture, face value of 1000. Okay, 10% is the coupon rate and face value is 1000 of the maturity of 10 years. Okay, redemption period is 10 years and is currently trading at 850 per debenture. Okay, now it is being issued at a discount. The bond is convertible into 50 equity shares, being currently quoted at 17 per share. Okay, so it is convertible into 17 equity shares, that is 850, and it is also currently trading as 850. Okay, it is redeemable at par. Okay, we'll anyways assume it. If it wasn't given, we will assume it as it will be redeemable at par. They have given good thing. If yield on equivalent comparable bond is 11.8%, then calculate the spread of yield. Okay, if the yield on equivalent comparable bond is 11.8%, okay, it's comparable bond, they are getting yield of 11.8%. We have to calculate the spread of yield on the above bond from this comparable bond. Okay, how much are we getting in our bond? Then what we have to do? We have to do by ATM only. They are given 2 rates. Okay, we just have to find the difference between it. So what we'll do first 11%. Okay, 11% rate, how much we'll get? 13% rate, how much we'll get? PV. Okay, and then we'll do redemption of that. Okay, by ATM method. Yield to maturity. Yield means your interest. Okay, and maturity means your redemption amount. How much is the value we are getting? We will do. Okay, first one we'll do it with 11%. Okay, they have done it out. Firstly, they have given the conversion price of how much? And they are given the conversion price of 15 to 17, that is 850, intrinsic value of 850. Okay, it is the same. Accordingly, the yield on bond 850 is equal to, we'll discount it by how much? We'll discount it by 8%, 11% first. Okay, we'll get an amount. Okay, how much we are getting? 90.90 is the cash flows. Okay, plus, wait a second, this is confusing, I'll show it to you from my book. Okay, it will be very easy. Question number 38, 1 to 10, we'll do it with 11% first. Okay, how much we are getting? 941, and we'll do PV of the 13%. Okay, 13%, how much we are getting? 837. What is my rate? What is my current market price? My current market price was 850. Okay, how much was my yield to maturity? We'll do by interpolation. 941 minus 850, 941 minus 837. Okay, we'll do into 2%. We'll get 12.76%. But 12.76%, what was my what was my yield on comparable bond? It was 11.8%. How much we got? 12.76%. We'll just take the difference between it. How much is it? 0.96%. Okay, can you see? Yes, 0.96%. So that's it. Only they calculate the spread of yield. It was the only point here. Rest all it was quite easy. So we'll do the last sum for today. It is question number 39. It is a good question. Okay, it is a good question. It seems small, but it is a good question. So we'll see what it is. So what it is? Calculate the market price of 10% Government of India security currently quoted as at 110. Okay, but the yield is expected to go up by 1%. So what they are asking, calculate the market price. The market price. So I don't see any redeem period. Okay, there is no maturity period, so we'll assume it as irredeemable. Okay, so for irredeemable, what we do interest divided by the percentage. Okay, so what is my current yield? That we have to find first. 10, we'll assume the face value as 100. Okay, 10 divided by 110. Okay, we are getting 0.909. 9.09 is my current yield. Okay, so how do we calculate irredeemable bonds market price? We do interest divided by its current yield. Okay, 1 plus KD. Will divided by KD. KD. Okay, so how much was my interest? 10 divided by MRC. Sorry. Okay, but the yield is expected to go up by 1%. Okay, so what they are saying is the yield of how much? 9.09% will go up by 1%. Okay, 10.09. so how much will it be? Okay, so how much will it be? It will be 10.09 First we got current yield, right? Current yield we got 9.09%. Now our new YTM is 1.09. So market price, how much was my interest? 10 divided by how much is my new YTM? It is 10.09. Okay, this point we were missing. Okay, it is 99.11. okay, $99.11. Okay, we made a mistake. We didn't see the question here, but yield is expected to go up by 1%. We didn't add 1% there. Okay, so in yield we are adding 1%. If I want to tell it again, explain it again, I'll explain it. Okay, 10% Government of India security currently quoted at 110. Okay, so what is its yield? 10 divided by 110. Its current yield is 9.09. Okay, but yield is expected to go up by 1%. We are expecting that yield will go up by 1%. So now what is my new KD? What is my new YTM? My new YTM is used for CMP. Okay, current market price. So we'll use the term as YTM only. Okay. So for irredeemable bonds, what is the formula? It is interest divided by your YTM. Okay. Interest, what is my interest? 10% only. So what is my new YTM? It is 10.09. If we do it, we get 99.11. Okay. So the next one will go. A bond with 7.5% coupon interest, face value is 10,000. Okay. And the term to maturity is 2 years. Presently yielding 6% interest. Interest payable half yearly. So here they are getting half yearly interest. So we'll have to, what to do? We'll divide the coupon interest into 2. Okay. Coupon interest will be half. Face value will be the same. Maturity will be double. Okay. And yielding 6%. That is the discount rate will divided by 2. Okay. So this will be 3%. This will be 4, and this will be 7.5 divided by 2. Okay. So how will we solve it? See, half yearly period 1 to 4. Okay. How much are we getting? 3.75. PV at the 3. We will do PVAF. Okay. We got PV. Okay. Fourth year 10,000 into PV 3%. Okay. PV factor at the rate fourth year. Okay. And we got this much. What is my intrinsic value? 10,278.91. Okay. 10,278.91 or 279. Okay. That's it for today. We have completed with bond yield and bond pricing. Do practice some of it. Okay. This one was quite tricky. We have to revise it again. Okay. And the spread of yield. Okay. This point we have to reconsider it. The annual, this one was 9%. Okay. This one, reconsider it. That is what, that from the day we are investing, from there we will count the maturity. Okay. Not the bonds actual maturity or since when it is trading. Okay. And this one, the spread one. Okay. It was quite easy. So yeah. Ta-da. Bye bye.